Good day, fellow investors. LYB stock analysis. We continue with our analysis of the cheap S&P 500 stocks, and this is one trading with a good dividend yield of 5.37%. The P ratio is 13, the market cap is 30, and over the cycle the company will do likely 2-3 billion in free cash flows that is usually distributed through buybacks and dividend yields. With the current market valuations, this looks like a cheaper good buy, but there is always a but. This is a chemical company specialized in polymers, thus plastics, wherever you use plastics industry, automotive, catalysts, whatever you can imagine, they are serving that industry, and that industry is very under the influence of the economy. If the economy keeps on growing demand, which is likely the global trend, but you always have some recessions here and there, and you can see here how demand for cars dropped in the great financial crisis and new housing starts. So that has then a huge impact on the business because they are just producing commodities, and the key here is capacity. How much you can produce, and then you depend on market prices. And if you look at their annual report, the first risk related to their business and industry is the cyclicality and volatility of the industries in which they participate. The business operations are subject to the cyclical and volatile nature of the supply-demand balance in the chemical refining industries. Historically, these industries have experienced alternating periods of capacity shortages, causing prices and profit margins to increase, followed by periods of excess capacity resulting in oversupply. Thus, this is the typical example of a cyclical industry, and you need to buy those when the stock is low. Then as the cycle turns, you make your money. All in all, the global growth trend is there, increasing population, increasing demand. So as this is a global commodity, it looks like there is still a good runway for the business. Let's check the financials. As I said, net income 2 billion, even if margins have already started contracting a little bit, they keep investing, doing buybacks, paying dividends. They are targeting growth in EBITDA by 3 billion by 2027. Keep in mind the market capitalization is just 30 billion, so just this incremental value, 10 times EBITDA, could add 30 billion to the market capitalization. And they are a capital intensive business, but once you build those factories, those are high cash producing cash factories in good times, and they are doing exactly that, high cash conversion and returning money to shareholders with dividends and share repurchases. There is a few billion of capex, a few billion of dividends on a 30 billion market cap. That's a good return there. They are investing also for growth, but Q4 was a little bit slower when you're looking at EBITDA, and it went down, adjusting for exceptional items, let's say around 25%. The big hit was with derivatives, lower margins there, and then you have a huge hit to EBITDA on average. But if you look at the long term, you can see this cyclicality with the business. Of course, 2020 everything was shut down, so that's a different story, but there is some cyclicality. But on average, they make the money over quarters. This quarter was slow, add a few hundred million of exceptional items, so still making money. And I think that if we look at the long term, they make on average 2 billion of value. If they grow that EBITDA by 3 billion, let's add another billion of value over time, growing global demand. So nothing wrong there from that perspective. And then you see a good dividend, 5%, likely to remain there. A good business at a fair price with a long runway ahead. That is what the business is priced for now. But why is the business this cheap? Well, when it comes to valuation, we have to think about recessions. Because the last recession was 15 years ago, true one, And then when a recession comes, okay, they have likely some impairments, etc., but they have negative net income, and therefore we have to analyze this business through the loop of, okay, will we have a recession? If a recession comes, demand for cars goes down, everything related to their business goes down, they have already invested in all the factories, so they have the capacity, and then prices and margins simply drop to very low numbers, and they need to survive that cycle until it gets up again, and that looks very, very ugly for the company and also for the stock price. So a good business, good price, everything looks good, but there is always the recession scenario here that makes the fear, and that's also why it is likely priced this cheap compared to the S&P 500 other stocks. I wish I could predict when the next recession will come, but when the recession comes, then it's time to look at these quality companies.